Hey, this is Mike from MoneyCore, and I just want to share some insight on the seven biggest mistakes that new investors make. And I can tell you because I've made all seven of these mistakes when I started investing about 20, 25 years ago. And when you make these mistakes, you very, very quickly dwindle your portfolio, and then you end up blowing up your portfolio. So what I want to do is just share these mistakes if you just started investing stocks and options, or you're looking to be more aggressive with your investing. I just want to make sure that I share these mistakes that I made to hopefully you don't repeat these mistakes, because it could literally save you anywhere from hundreds to tens of thousands of dollars. So they're just seven tips, and I think they'll be really helpful. So the first one, and I think the biggest one, is having unreal return expectations. Now, the S&P 500 on average returns 8 to 10% a year. If you invest, let's say, $10,000 into the S&P 500, you should expect to make this amount. And you should expect actually your money to double every 7 years. The problem is people want to double their money every year. I know I was like that when I first started out, and what happens is you make a lot of reckless trades. However, over time, you give yourself a 20, 25-year time frame. If you just put your money, like if you don't even want to invest in individual stocks, you just put in the S&P 500, you can get a 300% return of your money in like 21 years. And if you're investing like 10% of everything that you make, that's going to be in a substantial amount of money. Now, going to sort of the wide end of the spectrum of returns, you look at someone like Warren Buffett's Berkshire Hathaway has a 24% annualized return. And when you calculate that, that means your money doubles every 3 years, which is insane. Now, take that 21-year time frame that I talked about. Now, instead of having a 300% return, you have this exponential return that is much, much higher. So the most you can kind of think about as an expected return every year is kind of like Berkshire Hathaway, like a 24% annual return if you're really, really elite. Now you look at something like the ARK Innovation ETF that's been returning like 100% over the past years. That'll come down. That'll probably come down to like probably a 24% annualized return, like that ARK ETF, ARKK, is probably going to be the next Berkshire Hathaway, because they're just investing in disruptive companies. And Cathie Woods, the leader of ARK, is extremely smart. But that's from a realistic expectation, is you should expect on the low end, if you don't do anything but put your money in the S&P 500, expect an 10% return per year. And if you're really, really good, or you want to invest in something like ARK, or be really, really skilled as an investor, 24% a year or 25% a year. That's kind of the range. If anybody is selling you some sort of stock program that tells you, oh, I return 100% a year or 150% a year, that may be true, but that's not going to be consistent. And if someone's trying to sell you some course or stock signals based on that 1 year performance, then they're selling you a lie, and that's a recipe for disaster. So the number one big mistake is unreal return expectations. The number two mistake is trading put and call options, not trading options in particular, but specifically straight puts and straight calls. Now, I'm going to assume you know a little bit about options. This is not like how to trade stocks and options. So I think you know about what a call is and what a put is. The one thing you should really know is that 80% of calls that are bought expire worthless. And most of the time they're bought as protection or whatever. But if you're buying a call to try to get an outsized return on a stock moving up, or buying a put to get a return on a stock moving down, just realize there's an 80% chance you're going to lose all of your money. So you don't want to buy options. What you want to do is you want to be on the other side of this trade and sell options, because then that gives you an 80% chance of being profitable. Now, how do you do that? There are a couple of strategies that you can use, and these are the strategies I use. Covered calls, which is you buy a stock that you're bullish on, and then you sell calls against your stock. So for every 100 shares, you sell a call. And I like to sell calls at the 30 delta. And that means 30 delta means there's a 30% chance that that stock will hit that price. And I like to take profit at 50%. Also, on the other hand, I like to do cash secured puts, or secure cash puts. And that's the exact opposite, which is you're selling a put, but instead of owning the stock, you put up cash that is the equivalent of 100 shares of the stock. And I'm currently doing this and generating a consistent income with cash secured puts. And again, what I do is I sell puts at the 30 delta. That means there's a 30% chance that that stock at expiration will finish below that price. But what I do is because I take profit at 50% of the put's value, that gives me a 90% success rate. So definitely look at don't buy calls and puts, sell calls and puts. That's the way to go. From my personal experience, buying calls and puts, you lose money, I lose money buying calls and puts, but I make money selling calls and puts. So that's the number two mistake, is buying call and put options. The number three mistake is chasing hot stocks. Now that doesn't mean buying hot stocks, but you don't want to chase a hot stock that's been moving up too far too fast. If you look at stocks like Tesla or whatever, yes, Tesla has doubled, has gone up, actually gone up 500% this year, but it's had these 20% drawdowns during that time. And what happens is people will buy the stock for fear of missing out. And what happens is all stocks essentially eventually return to the mean, which is they go up very, very high, and then they return to this kind of this average level where they should be trading at. And what you want to do if you find a stock you like is wait for a stock to come to you. Now you can do this with cash secured puts. What I talked about in the previous point is where you sell a put a certain strike price, maybe a strike price you want to own. And if the stock doesn't come down to that price, then you just collect the premium from selling the put. If the stock does come down, then now you own that stock that you love at a great price. So if you like a stock, wait for it to come to you. Don't be in a rush to get it, because if you chase that hot stock, you buy it at that elevated price, it will come down below the price that you bought it at. You will see your investment in the red, that you're losing money, and then you get upset and you sell. I know I've done that many, many times when I started out investing, where I would chase, especially in the early 1999 and 2000 with the dot-com stocks. I was chasing the big stocks back then were like eBay, Yahoo, AOL or whatever, and I would chase them up, and then they would have these days where they were down 6-7%, and then I'd be down 20% on my position. I would get frustrated, I would sell, and then I would go back up again. So don't chase the hot stocks. Wait for that stock to come down to a price that you want it at. The number four mistake really is not researching stocks. So here's a great example of what happened to Amazon, which was one of the first big dot-com stocks back in the early 90s and late 2000s, is that when we had the dot-com crash back in 2000, Amazon went from $116 a share all the way down to $6 a share. Today, it's at $2,000 a share. Imagine all the people in the year 2000 who sold, at $20, at $10, sold to Amazon. So the point I'm trying to make is when a stock goes down, research why the stock is going down. In the case with Amazon was going down because the entire dot-com sector was crashing, so everything that had a .com on it was just being sold off. What people should have done was look at the fact that during the year 2000, Amazon was experiencing exponential growth in their company. Everything was moving up. Their profit margins were moving. They didn't have profit margins at that time, but the amount of web traffic was going up, the amount of sales was going up, the amount of revenue was going up. Everything was going up while the price was going down. So when you own a stock, make sure that you research what's going on with the company. Are they making profits? Are they getting increasing revenue? Are they coming out with new products and services? When you do that, you'll be more comfortable writing out the stock that's going down, because all stocks go down. But the best stocks in the world will have 50% drawdown. So you just have to know if a stock's going down because the general market is going down, then don't panic. Just hold on to the stock, because if you panic and sell, usually the rebound of that stock is much more violent than the fall of that stock, and then you miss out on the rebound. So definitely do your research. You could do your research by setting stock alerts on the stocks that you own, so you can read up on the news. And also look up on the quarterly earnings reports and the annual reports that come out. You don't have to read the whole report. You could usually find websites that will give you sort of a condensed summary of what went on with the earnings and the annual report. That'll help you feel more comfortable in holding stocks over the long term. The number five step is buying a falling stock. Now, the thing that you don't want to do is you never want to buy stock that falls below the 50-day moving average, and that's because 50-day moving average is a support line for that stock, and when it falls below the 50-day moving average, the next line of support is a 200-day moving average, which is much further below the 50-day moving average. And what happens is, even if this is a great company, you will not be able to stomach the idea of buying a stock and then watching it continue to fall. Some hedge fund managers can do it because they have a lot of money, and usually the stock that they're buying into is not a huge position in the overall portfolio. But if you're someone with, like, $10,000, $20,000 and you put $5,000 in a falling stock and that stock falls 20%, you're not going to be able to stomach the fact that you just lost $1,000 in 5 days. In investing terms, it's known as catching a falling knife. What you really want to do is, and this is the most ideal move, this is how I buy stocks, is I wait for a stock that's sitting above the 50-day moving average and it has a little bit of a dip and it comes down to a price that I like. Historically, a stock that's above the 50-day moving average will have that support and keep moving upward. But I just find it when it dips a little bit, maybe 3 to 5%, I buy in, and then it kind of recovers from that dip and moves back up. But if a stock is below the 50-day moving average, just avoid it, wait for it to move back up. If it's a great stock, it'll move back up. If it's a bad stock, you get to avoid it altogether and avoid a disaster. So that's the number 5 tip. The number 6 tip is using margin. Don't use a lot of margin. It's bad because if you have a bad drawdown, if the market crashes or the market corrects, instead of being down, let's say, instead of your portfolio being down 15%, you're down 30%. And if your portfolio goes down, or if an individual goes down 50%, you're pretty much broke if you're using 100% margin. And just to give you an example, one of the best performing stocks of the past 50 years, Berkshire Hathaway, has fallen 50% 3 times in the last 50 years. This is something Warren Buffett has talked about, why he never uses margin. He says, look, if you have used margin on Berkshire Hathaway stock, you would have lost everything 3 times in the last 50 years and missed out on one of the biggest investment opportunities ever. And even also Amazon, Apple, you name it, every one of these stocks has fallen 50% in their lifetime. And so if you're using margin, you're going to lose everything. So, I'm sure there are advanced traders that use margin. I've been doing this investing for almost 25 years. The only time I've ever used margin is if I've wanted to buy a stock and let's say I'm a couple $100 short of owning 100 shares, so I can do a covered call. I will go ahead and just use margin so I could have that 100 shares. I could do the covered call, and then I pay back the margin as soon as possible. But I would only use margin as a sort of as just little, when you need to cover up some, if you want to buy 500 shares and you don't have enough for 495 or whatever, just use the money to buy up use margin to buy up those couple of extra shares, and then pay back the margin as soon as possible, because you're paying interest every day. So if it's like a 5% margin, you're paying a percentage of that 5% every day. So overall, don't be overly dependent. Don't try to use margin to try to get outsized returns on your portfolio. That is a recipe for disaster. And finally, the final piece of advice, and this is the hardest piece of advice to follow when you're starting out, is getting emotional. Because if you make a lot of money, you get very emotional. You feel like you own the world. If you're losing money, you feel really horrible. The biggest 2 emotions that you're going to experience in investing is fear and greed. Fear of losing money, especially when your portfolio falls, and then fear of missing out if a stock's moving up and you don't own it, and you almost buy out of fear. Greed, you get greedy when you're trading on margin or you're making very risky trades. Wall Street bets, they talk about the YOLO trade, you only live once, and trading your last $5,000 on calls that expire in 5 days. That's just a recipe for losing all of your money. So here's a great rule of thumb. If you can't sleep at night, you have too much in your position. If you're getting up at 3 a.m. in the morning to look at the overnight futures because you have a risky position on, then that's too much. You just need to pare down your trade. And I know there's this feeling of, well, I don't want to trade too little because I won't get those outside returns. The key to making a lot of money in in stock and options investing is little trades and you trade often and you make sure you have an edge. That's one of the reasons why I love cash secured puts and covered calls, is that you have a historically you have an 80% chance of making money. And if you collect 50% of the profits, if you don't collect all of the profit, if you don't close out your position at expiration, you lose out 50%, you have a 90% chance of making money. And if you do lose money on those trades, those 90% trades, you do lose 4 times what you would have profit, but because you're winning 90% of the time, you maintain the edge. So definitely look at having trades that you can handle and trades you know you have an edge at, so you don't get overly emotional and don't get greedy, and you'll be fine. The stock market, the options market, there's so many opportunities to make money. Just remember, it's kind of a slow and steady progression to building wealth. Yes, there are people who are going to make $1 million, buying Tesla call options, but you also find people who make money, here and there in Vegas, playing blackjack. But the majority of people who do that, who make these risky trades, they end up losing everything. And I don't want you to lose everything. I want you to be able to steadily build growth. So I hope you enjoyed this video. If you did, please be sure to like the video and subscribe. I come out with every weekday when the market's open, I come out with investment news information that's about what's going on in the stock market and what to expect. And then during the weekend, I put more of these sort of generalized tips that help you become a better investor. So I hope you enjoyed this video. If you did, please be sure to subscribe. Thanks again. Bye.